How real estate can help you live tax-free. Man, this is going to be a great conversation. This is Matt Garland, NMLS number 58700, better known as MG the Mortgage Guy. We are live. We are blessed. Thank God for another day. Throw some praying hands or some gems in the comments if you are live and blessed on this beautiful, beautiful Friday, cold Friday, right? So let's get down to it. Like, comment, share, subscribe. If you're new here, welcome to the channel. Hit that bell for notifications because we got new videos coming out Monday through Friday. And you know what? We've been doing so many lives lately. I want you guys to make sure you're checking out the tabs on YouTube. If you want to watch the replays of these live, you have a live tab. So make sure you click that and watch those videos in full. And the videos tab, we're cutting those up. And so that way it can make it easier for you to watch those too. MGBookstore.com. You already know the vibes. Go to MGBookstore.com. Get the latest and greatest books. New book coming out next month too. Surprise, I told y'all I got mad books and I'm going to start dropping them. And I want to give a big shout out to everybody we met at in Baltimore yesterday, Tooks, we was on the road. We was in Baltimore. Oh, obviously I got Tooks Productions here with me. You don't want to show yourself in your lower third right now. That's what
There's a lot going on today, so I'm trying to keep it clean over here.
Okay, so we got Tooks Productions. He was in the building yesterday. I want to give a big shout out first to the whole New Balance family, the whole Shoe City family. They showed us great hospitality yesterday. It was amazing. You know, I never did an event in a sneaker store, so that was different. But that just goes to show you got to meet the people where they are. And, you know, oftentimes when people get to certain statuses and levels, they don't want to do certain things no more. So, and I'm definitely not one of those people. I don't care if it's 100 people or 15,000 at InvestFest. I want to give the people the information that they need to execute at that very high level. So shout out to everybody that was in Baltimore yesterday. So let's get to today's program. We got an amazing, and make sure, again, guys, throw some gems in the comments, throw some praying hands in the comments if you're feeling good this thank God it's Friday. What they say, TGIF, thank God it's Friday. Yeah. Thank God it's Friday, y'all. So throw some praying hands in the comments. But today we got a dope episode for you guys. Oh, hold on. Before I go that, make sure you guys download MG the Mortgage Guy show on all audio outlets. And if you want to work with me and my team to achieve your real estate goals, go to applywithmg.com and make sure you guys are checking the descriptions of all the videos because we put in the guest information because some of y'all be in the comments like, yo, where's their information? Check the descriptions, y'all. The description, we put links, we put everything that you need to apply, consultations, to buy the books, whatever it is. Check the descriptions of all these videos, please. All right, so today we're going to talk about how to save you guys money on your taxes with real estate, so that way you can potentially live tax-free. And we're bringing on one of my guys, man, Carter Cofield. He's a dope CPA. I met him, you know, I've been following him for some time. He has a really great profile. Profile on Instagram. Cofield_advisors, got a big following over there. He's always giving these gems about taxes and things of that nature. And when I finally got to meet him at the Path to Prosperity conference, shout out to Ash, Marvin, and Storm for having me there. You know, we shared the stage together, and this brother was on stage giving out so much game. I said, nah, we got to get him on the channel because we need that game live and in person. So without further ado, I need you guys to give a warm welcome. Throw some gems, throw some fires in the chat for my guy, Carter Cofield, CPA extraordinaire. Carter, welcome to the channel, my brother.
Yo, MG, was good, my brother? It's blessings to be here, man. I appreciate that phenomenal intro, bro. It was a blessing to be able to share the stage with you at the P2P conference, man. Been a big fan of yours for a long time, man. So it's only right that we came here together to bless the people on this Blessed Friday, man. So I'm excited, bro.
Look, man, blessings upon blessings upon blessings, and you're going to give them a lot of game. But I know my guy Tooks. See, Tooks is in his learning phase heavy. And I'll be honest with you, Carter, just so you know. I started my YouTube channel, like taking it seriously in 2019. I built it up. We worked hard on it, and then I just paused on it. And Tooks wasn't happy about that. I'll be honest with you. Right? Tooks wasn't happy. He said, no, why are we doing this? Because I wanted to focus on rants and gems. and putting out my products and my courses and things of that nature. So we built this channel up to like 60,000 people and then went dry for like 18 months. I didn't really put any new type of content or information out there. And when we came back from London this November, I say, yo, nah, people are watching my channel all across the globe. We got to go crazy. So we redesigned, well, Tooks redesigned our whole room, made it more of a set. And we just been, since November, I think 25th, you said, Tooks? Since November
Yeah,
25th,
something like
somewhere around there, we just been putting out content every day, new content. And the channel has grown crazy in the past 2 months. I mean, I think we went from 60,000 to now about 86, 87,000 or something like that subscribers. And we just been giving them game, man. No hose barred, no fluff. We ain't trying to give them, we give them motivation, but we try and give them the game. So Tooks, you know, we had an idea of putting Tooks involved in these conversations because he's in his learning stage. So that way, because he speaks for the audience, right? He is the
He asked me some
audience.
phenomenal questions before we got started. I'm like, bro, just save them. Just save those for the show. People need that. Like, you know what I'm saying? Like,
Yeah, so I want to start this convo with you and Tooks because he got a lot of questions. So, and I'm pretty sure the questions he has, the audience has as well. And then me and you can get into our dialogue, and then Tooks can really take it to the next level of his learning when it comes to taxes and everything like that. So, Tooks, the floor is all yours, my brother.
All right, here we are again. Okay,
talk to me,
so
brother.
now I can ask my questions. Let's get to it. All right, so the first basic question is going to be how you can set up your LLC as an entrepreneur or even as an investor, if they are the same in that sense. But how do you go about doing that? What's the best way to do it so we can save on some taxes?
Yeah. So first of all, is understanding the resources that you have to set it up. Like, I don't believe in going to other like websites to do it. It's a completely free website called LLCuniversity.com.
Okay.
And it walks you through how to set up an LLC in any state, and not only teach you how to do it, but to educate you as well. I believe that information changes situations. So I recommend people go to LLC University, follow the prompt to set up an LLC in your state. Depending on what state you are, is going to be potentially different prompts. So you want to first make sure your name is available, register your LLC with your state. Then you want to get your EIN, which is your employer identification number. So now you have your articles of organization, which is for the document for your LLC.
Right.
You have your EIN document, which is your business's social security number. Now you can take these two documents to a bank and set up a business bank account, because what we're not going to do is we're not going to have our personal and business money come out the same account. So we're going to set up a business account, and we're going to have all income from our business go there. All of our expenses from our business come out of there. And that is just a quick, easy step on how to set up your LLC properly for your business.
Okay, so now when I set up my LLC, it was done as an S corp. Now, can you explain what the difference is between that and like just setting up a standard LLC?
I can do you one better. I can give you what's called my entity creation flow chart, and it basically says what entity you should have at what stage in your business. Would that be helpful?
Okay. Yeah.
Okay, so before you start the business, you're already a sole proprietorship. Most people don't know, like, the moment you say, like, oh, I'm in business, like, you're a sole proprietor. So you don't have to file any paperwork for that. You're all good to go.
Okay.
Now, I recommend you set up your LLC before you start selling your products or services, because LLCs help you from an asset protection standpoint, right? So if you don't have an LLC in place and somebody tries to sue you because you gave them wrong advice, or your product made them choke or whatever, they can
Right.
sue you personally, take your personal home, your personal money, your personal investments, all that. But when you have the LLC in place, it protects your assets. So they can only sue what's in your business and not sue you personally, right? So before you start the business, before you actually go in business, I recommend you set up your LLC so you're protecting your assets. Now, an LLC is a perfectly good entity to stay at until you start making over $40,000 in net income.
Okay, I
Okay.
didn't know that. All right.
Say it again, $40,000 in net income. So if your revenue is 100,000 and your expenses is 40,000, you have 60,000 of net income, meaning you should be a S corporation. If you don't have that level of income yet, you should not be an S corporation, because S corporations, the taxes cost more to file. You have to have a payroll software. You have to have all these things. So it don't start financially making sense until $40,000 of net income. Once you have $40,000 in net income, you want to upgrade your LLC to an S corp, and the S corp is perfectly fine to stay at until you start making about $3 to $5 million a year, which you might want to switch an entity after that.
Okay, so do you have to? This is like kind of, I don't know, but do you have to do an ad in the paper with the S? Because I didn't have to do that when it was set up for me.
No. S corp, you literally file one document. Tax form 2553 is the S selection form, and you file that one document, and you're able to upgrade your LLC to an S corp.
Okay, so how do you go about paying yourself out of your out of your LLC?
Now we talking.
Yeah.
Now we talking. Okay, so guys, when you have an LLC and we have an S corp, you pay yourself in two very different ways. Okay, so when you have an LLC, I'll start there. The way you pay yourself from an LLC is simple. You simply transfer the money from your business account to your personal account. You can do that via Zelle transfer. You can do that via wire transfer. So when you pay yourself from an LLC to your personal account, just do a transfer. It's called a owner's draw. Okay, it's called owner's draw, and it's very simple. You can do it as often as you want or as little as you want. Now, when you upgrade to an S corporation, things change. When you have an S corporation, you must. Did I say might or must?
You said must.
I said must. Okay. You must pay yourself a salary from your S corporation every year. If you do not, it is the quickest way to get audited. So if you have an S corporation, you have to run payroll using a payroll providing software like Gusto or ADP. You have to pay yourself payroll at least once a year, and you have to pay yourself a reasonable salary. Now, I deem a reasonable salary to be 30% of your net income at least, but you have to pay yourself a reasonable salary at least once a year. If you don't, you have major problems.
Wow.
Do you have major problems?
So what he's saying is spot on, guys, because I have S corps,
Yeah.
and I have LLCs too, but the S corp is what pays you, pays me, pays a bunch of people. You know what I'm saying? So that S corp, that salary is very important, because oftentimes I don't think people really understand when you out here running a business, you have to run a business.
Yeah.
You know what I'm saying? Like, it's a business that you have to run, because you got your uncle Sam always watching.
Right.
So yeah, salaries is very important, and it helps your business too. You know what I'm saying? Because it lowers, it gives them more expenses.
Right.
So it's in the best interest of you as the business owner to pay yourself a salary. And then on the flip side, now you're paying yourself a W-2.
Yeah.
So now when you go for financing and everything like that, you can say, here's my W-2s.
Right.
Here's my pay stubs. Here's everything that you need. So it makes it actually a little bit easier for you to get approved for financing.
For
real estate.
Oh, for real estate.
Exactly.
So can you do like so with an S corp, can you just take money from your business to your, like, it doesn't work with that at all?
Yeah, so your questions, bro, too. So your questions are amazing.
Well, you said with an S corp,
you're asking for yourself, which is a legit question. So yes, so you can pay yourself payroll, right? Because again, you don't need to pay yourself more payroll than needed. That's why I said 30% of net income. If you need more than that, you can simply transfer money from your business account to your personal account, right? So you don't need to pay yourself a salary any more than you need. But if you need more money, you don't want to run payroll, because here's the thing: when you run payroll, you have to pay payroll taxes on that money. The other money
you have to pay payroll
that you have in your
taxes
business,
also.
Yeah, so you have to pay. So like if you pay yourself $100,000 salary, you're going to pay 15.3% in self-employment taxes. So that's an extra $15,000 in taxes you're going to pay for paying yourself a salary. But it's needed. But the rest of the money completely avoids self-employment taxes. So let's say your business had $500,000 in net income. You pay yourself that $100,000 salary. You pay payroll taxes on that. But the other $400,000 completely avoids self-employment taxes. That's why S corps help you save so much money in taxes. Because the LLC, you're paying self-employment tax on every dollar of net income you have. But with the S corp, you don't.
So let me chime in with this because I want you to break that down a little bit more in layman's terms because I
Okay.
I know that probably went over your head what he just said.
Yeah,
Right.
a
I got
little bit, a
excited,
little
bro.
bit.
I'm sorry. I
Right.
got excited. I got
No, you
excited.
good. That's why I'm here. Right.
Mhm.
So for you Tukes in the audience, what he's basically saying, you do 100,000 salary on W-2.
Right, I got that.
That
Yeah.
100,000 is basically 115,000 that your business is paying out because of
Okay.
the payroll taxes that you as the business is paying the payroll taxes, right? But you as a W-2, you still got to pay your state fed taxes on that 100K too. So your 100K is being taxed. So it's like you get twice taxed on both ends. You get taxed on the business side and you getting taxed on the personal side,
Right.
right? Now, that 400K that's left over or the 385 because you got the payroll taxes of the 15,000, you can do a distribution
Mhm.
to your personal stuff,
Okay.
right? And then you'll get a K1.
Hey man, look, I don't know if you gotta. You might as well put the CPA next to your name, brother, because I know CPAs that don't know half what you know, brother. So look,
Well,
if
look,
I was able to
Carter,
certify
brother,
you, I
I'm running
would.
businesses in real life. This is like, you know what I'm saying? We do this every single day, but you'll get a K1. But now that's why it's important for you to own real estate. Because now if you do a distribution, let's just say to your personal name,
Okay.
I'll keep it there. You do a distribution. Now that's basically like a 1099 for a business owner, right?
Mhm.
So now you need expenses on your personal side, so that way you're not paying taxes on 385,000. You see what I'm saying? Because now you're gonna owe money on that 385. The business don't pay the taxes.
Right.
Now you're gonna pay the taxes. So what I do is when I do distributions from my corporations, I don't do it to my personal name. I do it to another business.
Oh, this guy over here. This guy's cheesing.
I'm like, bro, I'm in my happy place, bro. We talking deep. I'm here for it.
Yeah.
Talk to him, Carter. Tell him how to do it, son.
Hey, look, I'm telling you, man, dog. This is good. So yeah, basically, y'all, to try to keep it, because we'll get deep in a little bit, but when you're a business owner, just don't upgrade too early, right? When you have an LLC, keep your LLC until you make 40K net income. When you upgrade to an S corp, make sure you're running proper payroll, make sure you're doing everything you need to do. And then when you have extra money, again, like MG said, real estate is the most tax advantage asset that there is on this planet. Like, say what you want about Donald Trump as a president, but when it comes to understanding tax law and mitigating his taxes, he does it through real estate. And it's one of the most tax advantage assets that we have. We're going to talk about why in a moment.
So, how do you, let's say if you have already, you have an LLC set up, you have an S corp, at any time, can you go about like just going into adding payroll? Like, is there something you have to contact your lawyer, or like, how does that work? How do you go and just pay yourself?
Yeah. So you want to get set up with a payroll software. I recommend Gusto if you're starting out. It's super cheap, super easy to use. The more employees you have, you might want to upgrade to ADP. But Gusto is a great, amazing payroll provider. So you have to sign up for a payroll provider, and then you have to go to your state website to create your profile for like unemployment taxes and stuff like that. So you have to sign up for your payroll software, hit your go to your state's website and sign up your business as an S corp there, and then you'll be good to go to start running payroll.
Solid. I mean,
And if you go to gustos.com/your state, they have a prompt that will walk you through how to set it up in any state you have for free.
okay.
Yeah, setting up, that's very important,
Yeah.
right? So you see how you get paid on clockwork?
Yeah.
That's through ADP.
Right.
So once you go in, you set it and forget it. Like, so even like my salary is set it, forget it. I don't have to worry about it. Like, it's set up. If I'm paying biweekly, it's 26 times the payroll's gone. It runs the payroll automatically. I get an email like the week before payroll. Hey, payroll's due. If you want to make any changes, go in and do it before this date.
Mm-hmm.
If I don't do it, then it'll automatically send the payroll based off of my settings for each of the employees who get payroll on the bi-weekly schedule. So it's super convenient. It's super easy. You as the business owner, you just got to make sure your bank account
Has the funds.
has the funds in it because you
Right.
don't want a negative. You don't want your payroll to bounce.
Yeah.
Yeah.
That's kind of embarrassing. You know what I'm saying?
Facts.
But let me ask you this, Carter. Now that we're talking about those accounts, right? How many accounts should a business owner have set up?
Oh man, this is good. We
Bank
go on places,
accounts.
y'all.
How many bank accounts should a business owner have set up?
Absolutely, guys. Before I answer that question, if you haven't read the book called Profit First by Mike Michalowicz, I call it like the financial Bible for entrepreneurs. So the book is called Profit First. I recommend every business owner have 5 business bank accounts, right? I know
Wow.
it sounds like a lot, but hear me out. And you can do these all at the same bank. So it's very easy to set up. You can set up all at one time, but you want to have one account for your income. So all your income flows into one account. You want to have another account for your expenses. All your flights, your travel, your Chipotle receipts come out of this expense account. You want to have an account for payroll, which MG was talking about. This is where your payroll comes out of out of your account. You want to make sure you have enough money in there to cover payroll. Fourth, you want to have a tax account. Saving for a future tax bill is imperative. Don't play yourself, right? So you want to set aside 20 to 25% into this tax account. And last is your profit or give account or investing account. I use this account personally to give. I give 10% of every dollar my business makes away to charity. You can have this account be for future investments or whatever, but you want to have those 5 accounts. Here's why this is so important. Number one, you're designating your money with the title. So every bank account you have has its own purpose. So if whether 10,000 comes in or 100,000 comes in, you're dispersing money to these accounts based on a certain percentage. This another great reason. This is just for business credit purposes. A lot of y'all, when y'all go apply for business credit, y'all have one account, and they're going to ask for 3 to 6 months of bank statements from that one account. They're going to see income coming in. They're going to see flights coming out, travel coming out, all these expenses. But when you have these 5 accounts set up, the banks don't say which account statements you have to give them. So you can give the bank the statement from the income account, and your income account shows all this money coming in all month and just these 3 or 4 transfers coming out. So you look like a more reputable borrower, and it'll help you get approved for loans as well.
Big Jim. I hope that ain't going for nobody head right
Nah.
there.
Nah,
Big Jim, yo. Throw some gems in the comment for my man Carter, man. Throw some gems in the comment because that was a real gem.
So, I have a question. So, how do you go about preparing yourself? Let's say if you want to get a house, or if you want to do an auto loan or something like that, and you know that you're going to look at your income. So, how do you go about filing your taxes that way in order to prepare yourself for that?
So again, LLCs are what we call flow through entities, and S corps are as well. So like any money that the business makes is going to flow through to your personal return. So there's no such thing as saying I'm gonna hold this $100,000 in the business so it don't show up on my personal income. You can't do that with LLCs and S corps. So all the money is going to flow down to you personally, regardless.
Okay.
So again, if your business makes money, then you're good. Here's a caveat that some people run into, because I'm a proponent of paying as minimal taxes as possible. Right? Like
Right.
write off as much as you can to pay minimal taxes. The most common question I get, MG, I'm sure you get this as well, is, well, if I write everything off and I show no income, how am I going to get approved for a home or auto loan?
That was my next question. Yeah.
I've been here before, my brother. I've been here before. So, so what you want to do is you want to like identify the year that you need to get approved for these loans and just do them all in 1 year. So that 1 year, you're not going to write off everything. You're going to show more income. You're going to have to pay a little bit more taxes, but you get your home loan approved, you get your investment property approved, you get your car, you get whatever loan you need in that 1 year. Because then after that, we're going back to deducting everything and mitigating our tax bill as much as possible.
So, is there a certain like amount that you should, or it's just based on whatever the home value is, or even whatever car? Is there a certain amount of money you should have, like, showing as income? Because taxes are, you got to pay a lot in taxes if you write everything. I mean, if you don't write everything off.
Yeah, so it really depends on the type of loan that you want to get. If you're trying to get a loan on a $200,000 property, it's going to be less. If you're trying to get a loan on $1 million property, it's going to be a lot. You need to show a lot more. But one extremely dope thing about taxes when it comes to real estate is certain deductions get added back to your tax return for loan purposes. For instance, depreciation. So last year I bought a Lamborghini at the end of the year for tax purposes. That was a $250,000 tax deduction, right? If I was to go apply for a loan today, they would add that $250,000 back to my income, in order to get approved for the loan because they add depreciation back to your tax return.
Wait, can
So
you explain that? That wait, so
okay,
explain that one
okay,
more time.
okay. So, the depreciation is the deduction that the IRS gives you for your property losing value over time,
Right.
right? So with vehicles that weigh over 6,000 pounds, last year at least, if you were to finance a vehicle that weighed over 6,000 pounds, you get to depreciate or write off the entire cost of that vehicle the year that you financed it.
You got a Lambo truck?
Yeah, yours.
Oh,
Yeah,
okay. I
yeah,
was gonna say because
yeah, yeah,
I was
yeah,
like,
yeah,
wait,
yeah,
what?
yeah,
I
yeah.
know,
Yeah,
like
no,
4,000 pounds. I know because I'm familiar with
you looked
exotics.
it
So.
up. But yeah, no, so I use that example to say like that got me a $250,000 tax deduction. But
Okay.
if I wanted to go buy a property, they would add that depreciation deduction back to my income to get approved because that gets added back for loan purposes. So when you're writing things off, you want to have write-offs that get added back for loans so that you can get the deduction, you can enjoy the deduction, but you also can still get approved for loans.
Okay.
That part.
Facts. Big
That
facts.
part.
Big facts. So now we're talking about homes. Let's get into let's get into this real
I was
estate
trying
stuff,
to.
right? So, all right, let's talk to because you said a lot right there. We're gonna probably break this down a little bit deeper for y'all. But let's talk about the first time home buyer, the homeowner. They're buying a single family property, right?
Mm-hmm.
That in this market right now, everybody because of the rates is buying down the interest rates and using points. Oh, we lost them. Carter, where you go?
I'm right here. I'm right here. But my camera says it's heated right now. Wow.
Oh, it
Give me one second.
overheated.
It overheated on him.
No, it said it's hot, so I need to pause because I've been shooting content all day. Wow. Give me one second.
Oh, yeah,
It overheated on him.
yeah,
Yo, that happens.
yeah. We've been
That's
there. We've been there
what.
with
So like,
that. Those.
what's the best workaround? Do I just wait or like?
You could just shut the camera off and then like it should reset once you turn it
Okay.
back on.
All right. Yo, this is embarrassing. What happened?
Nah, it's happened to us. I think twice in the past on a live.
Wow. Okay. Let me.
It's pretty common. It's pretty common with certain Sony cameras.
All right. I need to figure this out. All right. So, should I stream through my computer in the meantime, and then,
You
or
can if you
should we?
I mean, the information
Okay.
is what's more important. So
My bad, y'all.
No, you good.
you good.
All right.
All right, so while we're waiting on this commercial break, let me give the commercial break right now. All right.
There
So
you
look,
go.
if you guys are looking to buy real estate, take the black down real quick.
Oh, he's gonna go.
Yeah, because we'll be able to see him when he comes on the screen. So let me give this quick commercial break, and maybe we can chop this up for a quick commercial or ad for myself. All right. So look, mgbookstore.com. You already know the vibes. Get the bundles, guys. Get the bundles that come with the books. We got house economics and we got real estate investors manifesto. Both of them come with webinars. We got FHA 203K webinars. We got a 2-day real estate investing webinar. So when you go to mgbookstore.com, I pinned the comment in the live chat, and the link will be in the description as well. Make sure you get those bundles. I got a new book releasing next month. It's going to be a great book. I'm not going to tell you what it's about yet, but trust me, it's going to be a great book. Now, also, if you guys want to work with me and my team, Garland Mortgage Group, we are here to help you guys achieve your real estate goals. So a lot of you guys are always asking me, what states are you licensed in, MG? Can you help me in this state? Can you help me in this state? Well, let me tell you the states that we can help you in. Washington, California, Colorado, Texas, Illinois, Indiana, Tennessee, Alabama, Georgia, Florida, South Carolina, North Carolina, VA, Maryland, DC, PA, New Jersey, Rhode Island, Connecticut, Massachusetts, and the beautiful state of New York. All right. So there's a couple things you can do with me and my team. You can, if you're ready to get pre-approved or you're in contract and you just want to apply, you can go to applywithmg.com. If you want to book a consultation, you can book a consultation with my team or directly with me. That link is in the description as well. If you want a second opinion, if you're currently doing a real estate transaction and you want us to review your loan estimates to make sure you're getting a good deal, which I would highly recommend, because this week alone, I've saved people over $100,000 in fees, right? By giving them a second opinion. It is totally free. You could book a second opinion call. If you want to talk about FHA 203Ks and have a 203K or rehab loan consultation, you can book that consultation as well. So all of these links will be in the description of the video. If you're learning from me, I would appreciate it if you work with me as well. We want to be the #1 source for real estate education, and also the #1 source of helping you guys get to closing table and getting your funding together. All right, so applywithmg.com. Work with me in the Garland group. All right, that was my quick commercial break, Tooks.
Cool.
We
All right.
back. So
Now we
I don't know
got
how long
Carter
we back, but we back.
We are back, and we are live, and we blessed. Thank you for the commercial break opportunity, Carter.
It had to happen. It had to happen.
All right, so let's talk about the home buyer, the first-time home buyer, people buying homes in this market. They're gonna pay points in this market because the rates are higher. Pretty much every bank is doing deals with points. Now, are points still tax deductible?
Points are tax deductible to the purchaser. However, they're tax deductible to the extent of the loan. So you can't take all the point deductions in the year that you get the property. They have to be what we call amortized over the life of the loan. So if it's a 10-year loan, you can do it, you divide it by 10, or if it's a 30-year loan, you have to do the math. So you don't get the deduction. They are deductible, but the deduction is amortized over the life of the loan.
Is PMI tax deductible?
Yes. Here's the thing. Here's what I love about taxes in real estate. Pretty much any expense that is ordinary and necessary for you to obtain this property will be tax deductible to you as the homeowner or as the investor. So points, as you mentioned, PMI, mortgage interest, all these expenses are deductible to the owner or to the investor. That's what makes real estate so powerful. And we're just like on the tip of the iceberg when it comes to deductions. But if it's ordinary and necessary for you to buy your home or you to invest in that property, is tax deductible to the purchaser.
So for the home buyer, right? Because I know the deductions, they changed. You're doing standard or itemized deductions, right?
Mm-hmm.
In what case would it be more advantageous for someone to itemize their deductions? Because I know the deduction, I think the standard is what, 12,000 or something like that?
Yeah, 12,000
for single?
12,950 for single, and it's 2x that for married. Yep.
So in most cases, if they don't itemize, then they can't deduct the points, the PMI and everything. If they take the standard, especially if they're married, it's almost 25,000 in a deduction. There'll probably be more. Just taking a standard deduction if you're married, versus trying to do the points and the PMI and everything like that. Correct?
Absolutely. And like as the homeowner or purchaser, that shouldn't be your job. Your CPA should be like inputting into his system. His system should say, hey, if they itemize, it's going to give them this many deductions. If they select standard, it's going to give them this many deductions. And then your CPA should be picking whichever one is more, right? But again, you can't take any of these deductions as a homeowner if you select the standard deduction over the itemized deduction, right?
Very important.
Yeah, exactly. But for investors, we're talking different.
So now let's talk about the owner occupied, because as I mentioned, I got the house hackonomics book, right? We got house hackonomics right here. So it's teaching people how to house hack their way to wealth by using low down payment loans and buying multifamilies, right? Now with multifamily, owner occupied, so I'm gonna keep the conversation owner occupied. You'll be able to get more deductions if you own a multifamily property, because now the IRS recognizes you as a business owner and you have to file a Schedule E, correct?
Yes. So my first real estate property was in Chicago about 4 years ago. I bought a 3-flat, lived in one unit, and rented out the other 2 units, right? So 66.6% of my home was a business. So that means that 66.6% of all the expenses related to that 3-flat is a tax deductible business expense, right? So I love that you're teaching your students about house hacking, because you can literally live for free and enjoy the tax deductions of owning a real estate property. So 66.6% of your mortgage interest, your HOA fees, your homeowners insurance, uh, your management company, your repairs, all these expenses you get to deduct to the portion that you rent out your home. So for me, that 66% taken by all my expenses, I was able to live for free and enjoy some amazing tax savings, bro. It's literally like hacking life.
Even now, earlier you was talking about depreciation
Mm.
as well. So now you also, on top of everything that you just mentioned, you get to depreciate this property for what's that, 27 years or something like that?
Yes, let's talk about depreciation, because depreciation is the best deduction that there is according to the IRS, and I don't think it's going to change. So depreciation is literally what we call a phantom deduction, meaning you spend no money. You incur no actual expenses, but you get tax write-offs. So the way you calculate your depreciation is you take the value of your property and divide it by 27 and a half. So if the property's value minus land was $500,000, 500 divided by 27 and a half, that's about $18,000 per year that you get to take out as a depreciation deduction, right? If you make, that means if you make $18,000 in profit, your depreciation alone is going to wipe out all your income. So you're going to be earning money in real life, but you're probably going to be losing money on your tax return. It's a beautiful thing.
Look. Hold on, y'all. I hope y'all caught that gem right there. I really hope you caught the gem, because early in this conversation, when we were talking about if you have a business and you're doing a distribution to yourself, and if you did that distribution, I think we said $380 something thousand, right?
Mm-hmm.
To yourself. Now it's coming. You have to pay taxes on that money. So if you don't own no real estate, especially if it's in your primary name, right? You don't have nothing that can offset those taxes. So if you're running a business and you're making money and you don't have real estate in your name, you're actually doing yourself a tremendous disservice, because you need the real estate to offset those income taxes that you're making. This is the wonderful thing about real estate. Now, in most cases, we hope everybody's making 3, 4, 500,000 net, $1,000,000 net after expenses. But think about if you're a small business owner and you're making, after all your expenses, let's just say 40,000 in net income, and you K1 that stuff, you do a distribution, you K1 it to yourself, and you got a 3-family or 4-family, and now you're able to depreciate 20,000, 25,000. Now you just cut your income, your taxable income, in half. And that's not including the other 66% of what Carter just explained to us: the property management fees, your property taxes, the homeowners insurance you're paying. All these different things are on your Schedule E that the IRS is now recognizes as your business. So that was a major gem, and I hope our students understand this.
Yeah, and like, not to. So here's the thing: even if you're real estate, and I know you want to teach cash flowing real estate, but even if your real estate property didn't make you any money, it's saving you so much on taxes. It actually is making you money, like legitimate. So like, I think that real estate is, it's not a if, it's a must, right? If you want to be wealthy and you want to not just make the bag, but you want to keep the bag, you're going to need those real estate properties to offset your income in other places. Not to mention, and I don't even know if you have time to go into this, but like, as your property goes up in value, you get to take a loan against it, which loans aren't taxable. So now you're able to use that loan to buy another property, and you can keep doing this thing and enjoying depreciation on money that you didn't even use for the down payment.
Exactly. Now, all things Nissy, what we're talking about is these are owner-occupied investment properties, basically, right? Because
Mm-hmm.
you
Right.
getting the owner occupied rental properties. So This goes for whether it's an owner-occupied rental property that's depreciation, or even if it's a true investment property that's in your personal name. Let's just say you bought a 3-family, 4-family, and you didn't put in an LLC, you put it in your personal name. It's going to be on your Schedule E. So the same deductions that we're talking about or speaking about for the primary residence is the same if it's a true investment property. But I want to ask you this, Carter, because I think this is very important. Single family versus multifamily as owner occupied. It clearly, in my opinion, the multifamily wins hands down because of the tax benefits, correct?
Absolutely. Like, absolutely. I don't see a world where it would make sense the other way. I think if you have an opportunity to especially use like a FHA loan to get a multifamily property, that way you can live for free, take advantage of tax deductions at the same time. I think that's the best thing you can do for yourself and your family.
Ladies and gentlemen, House Economics, go to mgbookstore.com.
Hey, look, go get it now. Like, trust me.
Go
If you don't get it,
right
you're playing
now.
yourself.
The link is pinned in the live chat. And this is why, when you hear people saying single family homes is not an investment, and I just want to be clear, I am a fan of people buying single family homes because you need a place to live. And not everybody or every market is going to have multifamilies like the Northeast or the Midwest, like Chicago and things of that nature. And I'm a fan of black people owning real estate. So if you have to buy a single family property, go ahead and do so. Just buy smart. So I'm not advocating against single family versus multifamily. I want you to buy either which one that you can afford, right? But the math don't lie, right? On a single family side, you only really have 2 to 3 deductions. And those deductions you might not be able to realize because your standard deduction might be greater. So you're not really getting the tax benefit. So if you didn't own the single family house, you still would get the same standard deduction. So the single family, from a tax purpose, doesn't really help you. But that owner occupied multifamily, oh, hell yes. That baby helps you, whether it's negative cash flowing or positive cash flowing. It is helping you tenfold compared to the single family primary residence.
Facts. Absolutely. I couldn't agree more, bro. I couldn't agree more. So again, if you can go multifamily, I did it myself, so I can speak from experience, and I'm sure you can too, man. So definitely y'all check out that book if you don't know how to do it, so you can start learning and start earning.
Now let's flip the conversation. Let's talk to the investors. Wait, matter of fact, before I go there, what about ADUs? Right? So ADUs, accessory dwelling units, are now becoming a big thing nationwide. How does that now play from a tax perspective? Because now it's a single family property, but you collect rental income. Now the folks who are buying single families with the ADU, should they file a Schedule E to now include that rental income to now kind of hack? I'm not going to say hack when I'm saying the IRS in the same sentence. Hold on, let me retract that, right? Let me retract that.
Yeah,
so,
you don't need that clip going viral, bro.
We don't need that going viral. So let me rephrase this, right? Someone buying a single family with an ADU, can they get the same benefits as a owner occupied multifamily? Because if they claim the rental income on a Schedule E, technically it's an investment property too, right?
Yeah, so that's a good question. So I was living in California the past 3 years, and they didn't let AUDs wasn't a thing because you can do them in California. So I actually am not sure to answer that question. I can check really quickly, but in a perfect world, you should. But I honestly don't know that off the top of my head. That's a phenomenal question. Let me try to look it up and get the answer before we finish up.
All right, that's cool, because that's something that just came to my mind. Like, wait a minute, if you got the ADU, like, and ADUs is really like brand new to the scene, for the most part on a national perspective. So that would be definitely a good answer that we can probably get later on in this program. But let's switch it to now the investors. Now you're buying true investment properties. You're not using your personal name. You're buying them in LLCs. First of all, if you're flipping, let's talk to.
Wait, the answer is yes. I just looked it up that quick. So you have to report the rental income for the ADUs, but you also can deduct the cost of maintenance and depreciate the cost of construction for the ADU. So that was a great point there as well, bro.
Oh, wait, hold on. So you can claim the rental income on your owner occupied single family with the ADU.
Mm-hmm.
If you paid $250,000 to construct your ADU, you can deduct that full 250.
You have to depreciate that over the useful life of that construction, right? So it depends. If it was roofing, that's 10 years. If it's something else, it's 15. So you get to depreciate it, not all in one year, but you get to depreciate it over the useful life of whatever construction you had done.
So you can depreciate that the construction over the life, right?
Mm-hmm.
You can now the maintenance of the ADU you can depreciate. The rental income you can deduct. The if you got a management company, you can deduct. What if we created
Mm-hmm.
our own management company?
Yeah. So any expense that you incur in the year any expense that you incur gets deducted the year of. Any construction or improvements you have to amortize because the IRS says, hey, you're improving this property, so the value's going to go up. So we're not going to let you deduct it the same year. So you have to amortize it. But to your point, you recognize the income, you write off all the expenses, and you have to depreciate any improvements, which is the construction. But that's a dude. I even think of that. That was good.
So for
That was
all my
good.
single family primary residence people out here, if your state or county allows
Allows
you
it.
to put an ADU, whether it's a basement, a garage, whatever it is, it's probably in your best interest to have an ADU on your property from a tax play perspective.
Absolutely. And we just discovered that live. Y'all in the right place at the right time. Y'all at the right place at
Yo,
the right
drop some
time.
gems in the comment. Make sure you like the video. Shout out to Ahmad with the super chat. And we're gonna get to you, Ahmad, when it comes to your fiveplex question and everything in a second, because we're about to switch to investors. But I need everybody to like this video. We ain't got enough likes on this video right now, and not enough gems in the comment because that was a major gem. Now let's go to the investors. You're buying properties, true investment properties. They're not owner occupied. You're not house hacking. You're putting them all in your LLC. Well, that's why I kind of wrote this book too for the real estate investors out there, right? What are the tax benefits? Well, first of all, let's talk to, before we get to the landlords, let's talk to the flippers. What is the best business structure as a real estate flipper
You're
should I
talking
have?
good right now, MG. You're talking
LLC
good.
or S Corp?
You're talking good. So flippers are looked at in the same realm as business owners because all of their income is going to be ordinary because it's short term, right? It's short term. So the same example I gave earlier is the same for flippers. So LLC until you make $40,000 or more in net income. Once you start making more than $40,000 in net income, you want to upgrade to an S corporation. So flippers follow the same framework as business owners. Now, long-term investors, let me just say this right now. You will never have an S corp for a long-term investment portfolio, ever. You're going to keep it as an LLC. The reason is because S corps help you save on self-employment taxes. You don't pay any self-employment taxes on passive income, so there would never be a need for you to turn your LLC rental property portfolio into an S corp. So that's just a clear rule for everybody to know.
Should we have multiple LLCs for the properties owned? Say each property has its own LLC, or should there be one LLC for all the properties?
You talk. Hey, look. I don't know if you wrote questions down before you came in this interview, my brother, but you got some.
Now
You
we
got some heat
freestyling this.
today.
We
You got some heat
freestyling this.
So here's the framework I give individuals to apply to this situation, right? Because setting up multiple LLCs for every single property is going to be tedious, it's going to be costly, it's going to be a lot of maintenance, right? But having all your properties in one LLC leaves you open to a lot of litigational issues. So what I recommend is that you put as many properties in one LLC until you have about $250,000 in equity. Once you have $250,000 in equity in the LLC, I recommend you then create another LLC for another group of properties, right? Now, depending on how risk averse you are, you can do $500,000 equity or $1 million equity. I just don't want you to have $1 million or $2 million in equity in this one LLC portfolio, somebody trips, break an arm on one of your properties, and they sue you for the entire thing. So I recommend you group them, and once they have $250,000 of equity in one grouping, you then go to another LLC. So it really depends on how much equity you're having in your properties over time.
So wait, I just want to make sure I'm clear. Your recommendation is you got, Garland Holdings 1 LLC. I buy 3, 4, 5 properties, put them all under that one LLC, and then do the next property, Garland Holdings 2 LLC, buy the next 5 properties under that. Versus 123 Main Street gets its own LLC, 456 Main Street gets its own LLC. It's basically what you're saying.
Yeah, because if you do every single property, every single LLC, it's going to be you're going to need a tax return basically for each of those properties. It's going to be really tedious, right? So I recommend I'm trying to help people find a blend between convenience and exposure, right? So that they can make the best decision for themselves. Unless you live in a state where you can have a series LLC, then you can have
What's a series LLC?
a series LLC is a LLC setup where you have like the parent LLC, and you have a series underneath each parent, and each series is separated for litigation. So you can have a series LLC with 15 different series, and each series can have its own property in them. So if somebody trips and breaks an arm on one property, they can't sue you for the other properties in your series. However, only about 9 states allow series LLCs, I believe. So you got to see if your state allows it.
So basically, is that series LLC the same as a holding company?
Is not, because it's a lot less complicated to set up, and they're still under one entity for like all intensive purposes. It's just helping you separate them out for litigation. A holding company is its own entity with other entities below it.
So should someone who's scaling their real estate portfolio open up a holding company and then have the individual properties under their own LLCs, and everything flows back up to like the net income flows back up to the holding company?
That's a recommendation as well. I'm trying to think, is it any caveat to it? That's a recommendation as well that people can do. There's going to have multiple tax returns, but that's okay. But like, again, when it comes to real estate, you really want to make sure because it's so much equity in these properties that happen over time. You want to make sure you're covering your P's and Q's, and you're crossing your T's and dotting your I's, so that you can protect the equity that you worked hard to build.
So what would be the most advantageous for the real estate investor? Now, I'm talking about the real estate investor who scaled their business, right? They don't have 2 or 3 properties. Because if you got a handful of properties, you can manage a couple different tax returns and things of that nature, right? I'm talking about the person who's out here in our audience that might have 50 properties, right? What is the best way for them to structure their business? Holding company or several series LLCs from a tax perspective?
From a tax perspective, I would do the holding company with each LLC funneling up to the holding company, because it's going to be cleaner. There's not going to be any different tax savings, per se, because they're going to have the same tax savings ability. But you want to have that holding company. You want to have the LLCs underneath it. It looks cleaner. It's going to help you stay more organized, and it's going to help you save on taxes. So if you're in the real estate game like that, that should be your structural setup.
Throw some gems in the comments for my guy Carter, because he's giving a lot of information. And make sure you guys go follow him too on Instagram as well. Carter, let's keep this conversation going. I had to give a little plug for you real quick, because you're giving a lot of good information right here. So now let's talk about because the name of this video is how to use real estate basically to pay no taxes, right? Or to live tax free, or to minimize your taxes, whatever, right? As a real estate investor, we're not following pretty much Schedule E's, because when you start scaling, you have them in your business names. Let me say, not in your personal name. I'm talking about LLCs and corporations.
If you're smart, yeah, you want to have
If you're
them.
doing it the true investing way, right? They're not in your personal name, right? So hear me out, audience, right? So now you're not filing Schedule E's. You actually have physical tax returns for these properties or these holding companies or whatever. What are the tax benefits? Like because are we saving more money tax wise if we're putting them in our LLCs? And if so, what are the type of things that we can do? I know we spoke about depreciation. What about like the bonus depreciation? What about cost segregation? Like, what are these things that we can do to help us save more money?
Yeah. So when it comes to LLCs respectfully never help you save more in taxes than not having an LLC. LLC's main goal is to help you from an asset protection standpoint. So if a real estate property is in your personal name or real estate properties in your LLC, the deductions won't change, right? The deductions won't change for all intents and purposes. So to answer your question, outside of just the normal deductions and the depreciation of that you get from real estate, there is something that's called a cost segregation study that is just that straight gangster. Like a cost segregation studies are how millionaires, multimillionaires, even billionaires set themselves up to live tax free. So, do you want me to go into cost seg study and like give people why it's important and how they help?
So, first of all, what is cost segregation
Let's
and
talk about
how does it help
it.
real
Okay.
estate investors?
Let's get it. So, cost segregation studies is basically having an engineer come out to your property and segregate the different assets of the property out from itself. So, without a cost segregation study, you're putting all of the assets in the property under one umbrella. So, the cabinets, the counter, the roof, all this is getting put into the value of the building, which is depreciated over 27 and a half years, right? However, with a cost segregation study, we're segregating out. So now we're segregating, all right, what's the value of these appliances? What's the value of this flooring? What's the value of this roof? Because roofs are depreciated at 15 years, appliances are depreciated at 7 years. So now by segregating out the different avenues of your property, I'm able to help you depreciate stuff faster, right? So in our $500,000 example, what if $200,000 of the 500,000 was appliances? Now we get to divide. We get a depreciation deduction of 200,000 divided by 7 versus 500,000 divided by 27 and a half years. So we don't have to wait so long to capture the depreciation in the property. So on average, with a proper cost segregation study, you can depreciate 30 to 40% of the entire value of the property in the first year, which is crazy.
So instead of the cost, so in layman's terms, basically, instead of me depreciating over
27 and a
27 and a
half
half years, this cost segregation report allows us investors to deduct it up front.
up front. You get a huge portion, 30 to 40% of the value of the property can be depreciated in the year that you purchase it. So if you get $1 million property, you're looking at a $300,000 to $400,000 tax deduction in the year that you purchased the property just for owning it. So you remember that $400,000 net income that came from our business in our K1?
Yep.
All we do is take $200,000 of that, put a down payment on $1 million property, and we go receive a $300,000 to $400,000 tax deduction, wiping out all our income.
Yo, you gotta love America.
Gotta love it. Look, I
Don't.
tell people all the time, don't hate the player, don't hate the game, just learn the game so you can win the game. Period.
So cost segregation, you can only do this. Can you only do it one time, or can you do this every year?
So when you do it, it works. So you get that's your deduction first year. Then you get another deduction the second year. So you still get the rest of the life, but you're just fast forwarding it into the first few
So
years
you get the depreciation still over the 27 and a half years of
for the rest of
ownership
the. Mm-hmm.
on taxes, right? But the cost seg just gives you the immediate hit from day one when you first buy the property. So if you're actively buying rental properties every single year, you do the cost segregation every single year, and then boom, you're minimizing your taxes and still getting depreciation every year after ownership of these properties, correct?
And MG, think about what else you're doing. You're building your real estate portfolio every single year. So you're gonna look up and the money you're making from your property is going to be making more than your business.
Oh, where you go?
Yeah. Hey, I'm glad I got that point out before my camera went off. I'm right here, but the heating.
Yo, it's so hot with the gems that
Hey,
his
hey,
camera
hey,
is going out.
that's what's happening, man. It ain't my camera. It's that we giving so much heat in this interview, bro. Sheesh.
Yo, look, I hope you take the black off screen real quick. I hope you guys really understand. Tooks, do you understand what this man just said?
I'm trying, man. I'm trying.
Ask your questions.
It's a lot. It's because I don't really own anything, so I can't really. I mean, own real estate, so I can't really, you know.
No, but do you understand?
Not really, because I'm like,
What don't you understand?
I mean, all I hear deductions, and I'm like, what? It's a lot, man. It's a lot to absorb in one conversation for me. But I got for
Want me to break it down for you in layman terms a little bit again?
You could try, but I got exactly what I needed, and that's like
That's the beginning part of the conversation.
So I'm like, I get that now. That's perfect. So,
but this is why I always be talking about why we worried about the market cycles.
yeah, there's a lot more to
Like, why are we worried about that shit for? Why are we not worried about running the play of real estate? Because it's more than meets the eye than an interest rate or if the housing market going to crash and this, that, and the third. I keep telling y'all, real estate is brick and mortar, baby. Market go up, down, left, or right. I can still go touch my property. But one thing's for sure and two things for certain in this world. Death and taxes, baby.
yeah.
Death and taxes. You're going to die at some point and you're going to pay Uncle Sam. But if you buy real estate, you may not have to pay him as much as you think you have to.
Yeah.
Learn the game of the 1%. Learn the game of the wealthy. Let's bring our guy Carter back on. Looks like he's up and running again because this cost segregation, we got to continue this.
Yeah, so I'm on a computer camera, so it's not gonna be as clear on my
That's cool,
camera.
bro.
We good, kid, because it's black brilliance billionaires in the making right now because of this conversation that we have. And this is billionaire talk right now, real talk. The average Joe don't know nothing about cost segregation or.
I don't even know what that is. That's why he was gonna explain.
But no, so this is what before he went out, this is what we're gonna get into, so we could break it down a little bit more, right?
Okay.
So the cost segregation is basically, in layman's terms, it's a report that
what is I'm sorry, what is it
cost
called?
segregation.
Cost?
Cost, COST.
Okay, cost segregation. Got
Cost segregation is basically an engineer is doing a report and basically saying, IRS, this property is worth this. Here's the findings.
it. Okay.
Let's accelerate the depreciation. Instead of doing the depreciation over 27 and a half years, every year when you file your taxes, you get a lump sum of that up front the year you purchase the property if you do a cost segregation. So that way you get a larger deduction on your income taxes when you file them.
Okay. Got
Right?
that.
Now, Carter, how much does this cost segregation report cost, and how many properties do you need to own before you start doing cost segregation?
Okay.
So cost segregation studies can stem from as low as $500 to up to $5,000, depending on how big the property is, right? Because the bigger, the more work it's going to take. Here's the thing: the cost segregation study is tax deductible as well. So yes, you're paying for a cost seg study, but you get to write off the cost of the cost seg study on your taxes. So it can be anywhere from 500. I've seen as high as $5,000, but you don't have to own. You can own one property and get a cost seg study. There's no limit on how many properties you have to own to have a cost segregation study. Like my goal is to buy a new property every single year, get a cost seg, use the tax savings that I'm getting from the cost seg as my down payment for my next property. And I'm gonna keep doing this over and over and over again, build my real estate portfolio up and avoid paying taxes. So cost segs are literally, man, I'm trying to find a good way for layman's terms for people to understand it. It's a real estate hack that is not talked about enough. It's a real estate hack that's not talked about enough.
I never even heard of that.
So cost segregation, you can only do this for investment properties, correct?
Yes.
Oh, okay.
Not primary residences.
Nope.
Can you do this for owner occupied multifamilies?
I want to say no. I'm not sure, but in my research, it was only for strictly investment properties. I can
My
double check
research
that.
too.
Okay, okay, I can double check that. I think it's only for real estate property, only for strictly investment properties.
All right. So we understand cost segregation, how much it costs. You don't need multiple properties. You can do it on one property or a portfolio of properties. Let's talk bonus depreciation, right? What is bonus depreciation?
So bonus depreciation is basically a tax law that allows you to not have to wait for the useful life depreciation that we normally have to wait. So like for cars, for example, a car's useful life is 5 years. So if we bought $100,000 car, we would normally have to divide it by five, or you normally have to depreciate it over 5 years, right?
Mm-hmm. I
With
get
a
that.
bonus, but with bonus depreciation, you don't have to wait. You can get the full depreciation the year that you purchase the vehicle or equipment. So it's another way for you to accelerate your depreciation and not have to wait so long and get your deduction right now. So with the recent Tax Cuts and Job Act, they did bonus depreciation for 100%. That's why everybody was buying these Escalades, buying these G Wagons, because you could literally put a $10,000 you could put a $10,000 down payment down on a $150,000 car, and you would get $150,000 tax deduction. Meaning, you would you would end up saving like $75,000 in taxes. So by putting a $10,000 down payment down, you would get a $75,000 tax credit in return. This is why everybody was buying vehicles like crazy the past 2 years.
God bless America
Yeah.
But
and
here's
everything in it.
MG. Here's what people need to understand, bro. The tax code is nothing to be scared of. The tax code is literally a rule book that's teaching us how to avoid paying taxes. 95% of the tax code talks about how to avoid paying taxes. 5% talks about how to pay taxes. So we need to understand that if we focus on the abundant 95%, we can live tax free. They want us to, because if we do, we're just doing their job for them. The more real estate we buy, the more money we pump into the economy, the less money they have to print. So if you do what the government wants you to do, they'll give you massive tax breaks for it. If we understand that as a people, we'll be good to go.
Can your depreciation be recaptured?
If you sell before the term of the life of the depreciation is up, you have to pay depreciation. You have to pay depreciation recapture. So, in my car example, if you were to buy an Escalade and get $100,000 write off, and you sell it the next year, 80% of that you're gonna have to pay back as depreciation recapture, which means you can't get the deduction and then sell it the next time in the next year. That's not how it works.
So how do you avoid the recapture of your depreciation?
Don't sell the asset.
What if it's a lease?
You can't depreciate something that you're not owning.
Correct.
So you can.
So
Yeah.
if it's the real estate, let's keep it real estate then. So if it's the
Okay.
real estate, right? I buy property 2023. I do my bonus depreciations and do everything I'm doing, but I wind up selling this rental property 5 years from now. So now, it'll be prorated basically.
Yeah, it would be prorated. You have to pay the depreciation recapture based on the prorated amount that's left to depreciate.
So anytime within that 27 and a half years, that depreciation could be recaptured once you sell the asset.
Yes, especially if you do a cost seg study and get majority of it up front, and then you sell before that 27 and a half years is over with, you could have depreciation recapture. Or you can be a clever investor and do what's called a 1031 like-kind exchange.
I was just about to go there. Go ahead,
Okay, I
brother.
see.
Go
I
ahead.
ain't know if you was leading me there,
Yeah,
or you wanted to
I
do
definitely
it.
was.
But,
You
you
picked
had
it up, brother. You picked it
You
up.
had it at the rim, bro, and I'm like, I don't know if this oop is for me, but I'm taking it.
That oop was for you, brother. You caught it. First of all, I
Oh
need y'all
man,
to understand my interviewing skills here, right? Because I be talking my shit on the low, and y'all not even understanding what I'm doing right here, the way I'm asking these questions, Tooks, and the way I'm setting this shit up for y'all, man. Y'all gotta understand. Let me start up. Let me shut up. I'm sorry. Go ahead.
no. Talk your mess because I've done interview after interview after interview after interview. I don't think somebody's gotten more value out of me in one sitting than what your audience is getting right now. Like from the level of easy to like billionaire tax hacks, like in one interview, bro, I don't think it's ever happened.
Drop some gems in the comment for MG over here, all right? I'm not just the mortgage guy, bro. I'm telling you I'm great at what I do, Tooks. You just gotta let me just do me, bro. And I'm freestyling this too.
Bro, I'm just
Tooks, I'm
listening.
freestyling this too, bro. I ain't write nothing down.
Hey, Toots, can you take me off the screen right quick while I switch my camera out and try to get some better quality?
Yeah, let's do a
Yeah, I
commercial
got you.
break
I
for
got you. I
MG
got
real
you.
quick, right? This is a commercial break for MG that y'all need to download every podcast that I do, Rants and Gems on EYL Network and MG the Mortgage Guy Show, because I'm trying to tell y'all, I'll be setting y'all up for success when I be having guests on, and even when I don't. I set y'all up for success, and the only thing I ask for is support. I'm giving y'all $1 million worth of game for free right now. Tooks, I could charge for this.
Yeah.
I
I do
literally could
charge
have
for
had a
this.
whole webinar behind this, charged $300-$400 for this game. This is what I was
Let
trying
me
to tell you earlier, bro.
I don't know what you was
look.
trying to tell me
You know
earlier.
what I was trying to tell you earlier,
don't.
bro. I could be on, I don't have to do this on YouTube. I can do this as a webinar. I can charge. I could make a whole course. I can say, Carter's run a play. But I'm giving free game to the people because this is where I'm at in my life. I want to give as much possible so our community can execute at the highest levels. So if I ask y'all to like the video, like the damn video, please.
So what's your point? What's that got to do with
My
me?
point is, because I'm letting you know along with them, because you're the audience.
Oh, okay, that's fine. Like, I never said you shouldn't be doing this.
I'm just saying. I'm just letting you know.
Carter, we good?
Yeah,
You back on, brother?
we good, bro. That was just I'm just laughing at y'all.
Oh,
Yo, we go
But no,
back and forth like this.
yeah, this is every day.
I've literally charged people rightfully so thousands of dollars for the information, tens of thousands of dollars for the information to sit down and have a one-on-one consultation and go over their tax plan and their tax strategy, giving them a cost seg play, giving them depreciation, telling them what like this is thousands of dollars of information for free, and I love it here.
I love it here too, brother. So let's talk about this 1031 exchange because we was
That's good.
talking about recapture, depreciation recapture, and then you were saying the way to be savvy about that is to do a 1031 exchange. Let's break.
Um,
First of all, what is a 1031 exchange?
Yeah, that's what I was gonna ask.
yeah. So no, it's a very good, very good question. So a 1031 like kind exchange is basically saying like, hey, if you sell this asset, this real estate property, you would normally have to pay taxes on the gains from the sale, depreciation, recapture, all that jazz.
Right.
However, if you sell this property, but you plan on buying another property in a specific amount of time, we won't charge you taxes or depreciation recapture. We won't charge you anything of that nature right now because we want to incentivize you to keep investing in real estate. So if you sell this property, as long as you buy another like kind property, you won't have to worry about paying taxes or anything for until you sell again. But here's the thing: if you sell, buy a like kind property, sell, buy a buy a like kind property, sell, buy a like kind property, you can keep pushing back the depreciation of the gains of the capital gains taxes you're going to have to pay. You can keep deferring it and deferring it and deferring it.
That's crazy. This is legal too. This is like
This is legal.
But
What's
but
capital gains?
okay, so capital gains taxes is taxes you pay when you hold an asset longer than a year. So if you buy a property at 100,000, you sell it at 300,000, you got to pay taxes on that $200,000 gain. But it's instead of paying the 37% ordinary income tax rate, you would pay like a 20% capital gains tax rate. So it's a tax rate for being an investor, but it's lower than ordinary income tax rates. But in my example, and not to get too far ahead of us, but like again, with a 1031 like kind exchange, you can sell, buy like kind property, sell, buy like kind property, sell, buy like kind property, and then when you die, if when you die, your kids receive what's called a step up in basis in the property. So all that means is that if you die, that tax bill that you owe just died with you. And now your kids get to start with all this real estate portfolio that you never paid taxes on when you sold it. Does that make sense?
Yeah, that sounds pretty illegal, but I guess it's
it sounds so good. It
nah, I'm
should be
playing.
illegal.
That's crazy. That's crazy. But so it could be any property.
Yeah.
Like,
So
what's the limitations on that?
Well, it has to be a like kind investment property. So if
What does that What does that mean though?
So it really just means it has to be another like investment property. So if you sell
Investment
a
property,
two
okay.
flat, if you sell a two flat and then you use that proceeds to buy an 8-unit apartment complex, that's fine. If you sell an 8-unit apartment complex and buy a 40-unit, that's fine, right? Like you can just keep upgrading your real estate portfolio and never paying taxes on the gains. And then
Gotcha.
you keep deferring your tax bill. You keep deferring it, deferring it, deferring it, and when you die, your tax bill dies with you.
Now, let me say this. We're talking capital gains when you are an investor.
Right.
Now, capital gains when you are primary residence is different.
Okay.
Right? Carter, please explain when you're primary residence, the capital gain structure.
Yeah. So, well, here's another. So when you own a primary residence, right, and you want to sell that primary residence, you're gonna have to pay capital gains taxes on the sale. But there's something called the homestead exclusion, which means if you live in the property 2 out of the last 5 years and you decide to sell that property, you don't have to pay taxes on the gains. $250,000 single or $500,000 married. So if you're living in a property for 3 years and you want to sell it, and you've lived there 2 out of the last 5 years, you don't have to pay taxes on the sale because you live there and you get what's called the homestead exemption.
So let me break this down in even more layman terms.
I kind of understood that.
No, I just want to put this into real life.
Okay.
Yeah.
You purchased a house in 2019 before the pandemic, aka the bandemic, came.
Right.
Mm-hmm.
You lived in this house now, and your house became up and stuck, and you got 2, 3, 4, 500,000 worth of equity, which is common because of people who purchased 2018, 19, or whatever the case, and they held those and they lived in those properties.
Mm-hmm.
Now, if they go to sell it, if they're a single person, if this was you, and you were single, you made 250,000, you pay no taxes on that money. It's free and clear money.
Right.
And if you are married, you don't pay no taxes up to $500,000 in profit or capital gains. So if you made 600,000, you only pay capital gains on 100,000, not the full 600. If you made 300,000 as a single person, you only pay capital gains on the 50,000, not the 250.
Okay.
Guys, this is why I tell y'all real estate is the best shit in the world. You see, I don't talk tax plays like that on that EYL episode. I think that was my 4th time on or something. I lose count at this point. Shout out to my guys. But I gave a little something, but I don't talk about this because I'm not a CPA.
Yeah, not CPA, right.
But you know it though.
Oh, hell yeah, because I do this in real life. I do this in real life. I'm not just sitting here, and that's why I don't have to prepare, Tukes, or anybody, is because if you know real estate, if you know taxes, if you're a CPA, and this is what I tell you guys all the time too, right? And we're going to wrap this up after this because Carter got to go in 10 minutes, right? But I want to say this to everybody. If you are in a field and you don't master your field, see, too many people are trying to be a jack of all trades and a master of none. I say this all the time. You see, I don't need to prepare when I'm speaking to people. Even yesterday, what did I do? The moderator wants to know what I want to talk about. Talk about whatever you want. You're in real estate, I'm in real estate. Let's have a conversation. Because I know what I'm doing. I don't have to prepare for something I already know, and I do in real life. Like, I actually do real estate. Carter, we didn't prepare. I came in late. And as soon as I came in, 10 minutes, let me post that I'm going on live. And then we went live. And I said, you and Tooks would start the conversation. That's how it went. I have no
Fact.
questions or nothing. I'm going to just talk taxes in real estate because I know what my audience needs to learn. Because I know the stuff that I would love to keep speaking about on these channels, but I'm not a CPA. And I don't want to give people tax advice because I don't want to get nobody jammed up if I say something wrong. But I know enough to have an intelligent conversation with a brother like this because
A,
I
a very
study.
intelligent
I'm doing it
conversation.
also.
Very intelligent conversation. We went deep, dog. Like
No,
that was a very
this
intelligent
was
conversation.
crazy. But I want to leave them with one last gem, Carter, before you get out of here. There was a strategy you was telling me offline, and I said, "All right, I can't remember the name of the strategy because you asked me if I ever heard about it, and I said, no, I haven't." So I want you to kind of lay. This is another layup for you, bro.
Yeah, yeah.
Like one last gem. What's another tax strategy that us real estate folks can use to minimize or live tax free?
Yeah. So yeah, you really squeezing all the juice out of this conversation. I love it, man. Like, hey, look, y'all but thank my dog MG for this because like I'm telling y'all, like this is probably the most game I've given in one interview in my entire life. But we're here and I love it. So the strategy that I was talking about, because I want to confuse people. So everything that we just said was applicable to like real estate investors and like professional real estate investors. But here's the thing: if you're not a professional real estate investor, the how much depreciation you can take in 1 year is kind of capped, right? There's called passive loss rules, which means that if you're not like really a professional real estate person, although you have all these deductions, you can only take up to 25,000 or 50,000 depending on how much money you earn. So if you're part-time in real estate, you will have some limitations to how many deductions you can take. You get the deductions, but you can't take them all in 1 year. The strategy I was telling you about, MG, was that I want to say it because I really don't want to confuse people with this. It's deep, but with Airbnb, short-term rentals don't have the same rules as long-term rentals. So if you get these properties, you're like, yo, man, I have all these deductions, but because of what's called passive loss rules, I can only take 25,000 of this $100,000 of depreciation I'm supposed to get, and now I got to keep rolling forward this, year over year over year, and it sucks. If you instead buy the property and turn it into a short-term rental, you don't have to abide by those passive loss rules. So if you own a property and you Airbnb it out, you can take the full depreciation deduction without having any rules or any limits for not being a full-time real estate investor. It's something deep that we'll have, I feel like we went deep enough that I don't want to confuse your audience, but like it's a way to get around a big rule that stopped non-professional real estate investors from being able to take all their losses the year they wanted them to take. So I'll leave it there.
Yeah, we'll
Because
leave this for a future webinar.
yeah, this one's deep. Like this one's deep. Yeah.
Yeah, we'll leave something for next time because there's a lot. I have a lot more in my head that I want to talk about, but I think we gave them enough to where our students can, class was in session. I hope nobody was in the back of the class on this one. I hope you guys got a lot of notes for this class. Carter, are you taking business nationwide? Like, how can our students work with you and your firm?
I love it so much. So if you go to Cofield_advisor on Instagram or Twitter, all social media platforms, I have a link in my bio that says schedule consultation. I also have amazing ebooks to help you save on taxes and things like that. So just tap in with me on all social platforms, man. I just love giving free games. So if you tap in there, you're going to learn a lot. So let's get it.
The free game was monumental. Now imagine once
How much?
imagine when and this is keeping it real, and this is why I say, look, if you want to work with me and my team, work with me, because imagine what I'm telling you for free. Imagine when professionals, right? I'm a licensed professional, he's a licensed professional. Imagine when we actually look at your profile and we're able now to really do a deep dive on your current situation. Imagine the play that we can set you up for generations. So this is why I like to have conversations with licensed professionals. Although we are on the internet, although we might be considered influencers because of our followings and we're on stages and
We were
things of that
professionals
nature,
first.
we're professionals first. We
Mm-hmm.
abide by certain codes of ethics. You know what I'm saying? And our goal is to be transactional and to help you guys accumulate wealth no matter which way you're trying to go. So I would encourage you guys to work with Carter and his firm, book your consultations. This is tax season, baby. This is the time you need to be doing your tax planning, doing your taxes, and this is a real estate channel. So if you want to live tax free, Carter understands real estate clearly. And this was like an interview, not just for y'all, but to see his knowledge. So that way you feel more comfortable with working with him and his firm and helping. So that way they can help you go to the promised land, which is minimizing your taxes. All right. Carter, we appreciate you. I know you're short on time. Look, I appreciate you, dog. We're going to clip this bad boy up.
Hey,
Be prepared for your comments and your DMs to go in shambles.
I love it, man. And we got to run this back, brother. We got to run this back, man. This was so good. This is probably again one of the best interviews I've ever done in my life. So man, I just want to thank you for giving me the opportunity on your amazing platform, bro. Whenever you wanted to run it back, bro, just hit me and we going crazy.
Man, thank you, bro. I appreciate those kind words. Everybody tap in with my guy Carter on all social media platforms. Book the consultations, guys. Get these. It's tax season, baby. Let's run these plays and let's run this bag up because it's here for us, man. Carter, we appreciate you.
All right, brother. Peace.
Tokes, what you think about this?
I learned whatever I need to learn.
You learned
But
whatever
this
you need to
video
learn.
will be up. I appreciate you, Carter. Thank you so much. But this video will be up. I'm gonna take him off. We gotta go.
Peace, Carter.
This video will be up for me to replay. So, and I'm gonna do that with the other ones too. The other ones, because it's a lot of information. I know
This got to get chopped up.
Yeah, even the first half is good for a clip for people who don't know how to set up an LLC.
Absolutely.
I mean, I have an LLC, but I wasn't really benefiting from any taxes or anything like that with the way I have it set up, because I'm used to I was W-2 my whole life, so it's a little different. But yeah, it was definitely a lot of information. This is a great episode for sure.
Nah, this was a dope ass episode. There's so many gems in here. I'm just sitting back like, oh my God. Like, oh my God. Look, throw some gems in the comments if you like this type of content. Class was in session, students. Professor MG was here.
What's his IG? So you could put it in the
Carter _advisor. Carter _ I mean, no, not Carter. I'm sorry. Cofield. Cofield. COFIELD _advisor. Cofield advisor. So his last name _advisor. And I'm
I just put it in the chat for you guys.
You put it in the chat? Okay,
Yeah.
good.
So you guys can check him out on Instagram. I also have it in the description as well. And also, I'm not sure if he has a website that I could put in the description.
It's in the link in his bio.
Okay. Yeah, so you guys can definitely check it out.
Link in his bio for all that information. But we ain't got enough likes on this video. And this video should have like 200. It's 300 of y'all in here, whatever. It should be 300 likes. I'm sorry. Because this was real game. This wasn't no fluff. This wasn't no like trying to get you jammed up type of shit. Like, first of all, we don't do that type of content on our page anyway. We're not those type of people. I told y'all, when I put out anything, it's stamped and approved. It's real information from real people that doing what they say they're doing, right?
Yeah.
So this is kind of like a vouch. When you come on anybody you see on my channel is basically like I'm vouching for them. So you guys can feel free and feel comfortable to go out there and explore and interview them yourself. Do your due diligence. You know what I'm saying? Because shit does happen. But do your due diligence and make wise decisions when you hiring professionals. But this was a great episode, man. Lots of information, man.